and I have an IBIT position, which is the Bitcoin ETF. So this is actually mirrors spot Bitcoin as far as the actual price of Bitcoin. So I put on a new position in this yesterday. This is down $1.50, which is a 2.5% down move because Bitcoin's down about 2.5%. So obviously this just mirrors what Bitcoin's doing. Bitcoin was at all-time highs yesterday. So even though this seems like a pretty big down move, it's really nothing to be concerned about. Yesterday I put on this brand new strangle on IBIT, the 48 put and the 100 call. I received a credit of $227 for selling that strangle. The buying power reduction was, I want to say, right around $1,000, maybe $1,200. You know, wasn't crazy as far as the buying power. It's really reasonable. And obviously, I like this trade as far as if Bitcoin went down, I don't mind taking assignment on the put. I'll take 100 shares at $48 a share if Bitcoin had that kind of correction. Because if Bitcoin, you know, comes down 20%, 25%, yeah, I'd buy it at those prices. That's fine. I'm not worried about the put at all. And the call side, which is the scary side of this strangle, well, you can see I sold the 100 strike call. You know, I'm 41 points out of the money on that call. So it would take a huge rise in Bitcoin for that call to ever be a problem. Now, just because it would take a huge rise in Bitcoin for that call to ever be a problem doesn't mean it couldn't happen. Because if I look at the delta, that's an 8 delta call. So the market is telling me there's an 8% chance, roughly, that Bitcoin, or IBIT in this case, could rise to that $100 level. So never think something's an impossibility. Because I look at that call and I say, there's no way that could ever happen. Well, the market is pricing it like, hey, you know what? There's at least an 8% chance of it happening. You know, that's one thing you have to, especially if you're new to trading and really just life in general. You know, one of the things when you're trying to calculate odds for any event happening, never ever assume that anything, I don't care how ridiculous it is, never assume that the chances of any event are 0%. Don't do it. The most wild and ridiculous thing you can imagine, always assign it somewhere between 5 and 10% chance of happening. Just as a default, just always do that, right? You better at least account at least 5 to 10% for even the most ridiculous thing to happen. Because if you ever start getting complacent and thinking things that have 0% chance, you know, oh, that'll never happen, that's when that crazy thing actually does happen. And that's when you get run over. Yeah, well, you know what? That is by far the question I get the most, specifically about options strategies. People ask about covered calls more than anything else. And the most common question they ask about the covered call is, I have this covered call that's in the money. What do I do? Right? Well, you close the trade for a win and, you know, you're happy, right? That's what you do. Yeah. Yeah, some TikToker must have said that covered calls are the holy grail or something. Yeah, that's not a TikTok. I mean, covered calls are, you know, one of the more popular option strategies, always have been, because so many people, when they come from trading stocks to options, they already have stock, right? Most of them already have shares of various companies. So it makes sense that the first strategy they want to try out is selling covered calls, because they've already got the stock anyway. Why not sell calls against it? And then, of course, when the trade goes well, you know, the price of the stock goes up, and then they're like, well, what do I do now? Well, you're going to get assigned on your call. You have to sell your shares for a profit, by the way, right? You're selling your shares at a profit, plus you got to keep 100% of the premium for the call you sold. Like, that's not a problem, right? If it's a problem, it's a first world problem, right? That's not a serious problem. Yeah, not an urgent request, but I would love to hear your thoughts on strategies for stocks you'd like to hold long term. Well, one of the things you could do, if you're one of these people that you like mainly buying stocks just to hold them long term, it'll depend on just what you're doing. Like if you're essentially investing in just, which most passive investors often are just investing in one thing. They're just investing in the S&P 500, you know, typically a product like SPY, or they might diversify a little bit by doing, you know, like 3 or 4 different ETFs. They'll do a little SPY, a little bit of the Qs, maybe a little small cap, you know, exposure with something like IWM or something, maybe, you know, some bond ETF, you know. But if you're doing things like you know, in 10, 15, 20 different individual companies, like you're doing things like Apple and Microsoft, things like that, you'll do that a little bit differently than just, accumulating shares of SPY. But for the most part, especially if you're doing those individual companies, instead of buying the stock today at the prices today, I would always sell a put to get long stock. I just think it makes sense because you're getting the premium on the put. You're not having to put up very much buying power at all. If you win on the put, you make a little bit of money. You didn't put up a lot of money to make that money. It's a great trade. And if the stock really goes down, well, now you get to buy the stock at a steep discount compared to where you would have bought it at today's prices. So I always like, if you want to get long stock, sell puts. I just think that makes sense. Yeah, and the key here is if it's a stock you really want. Now, some people will say, hey, I really want the stock, so I'm going to run the wheel, I'm going to sell a put, and then their put is in the money, and they freak out. It's like, oh, well, I really didn't want the stock. Well, if you didn't really want the stock, then why were you planning on run the wheel on it anyway? So, but if it's you're thrilled to actually own stock, maybe you already own shares of this company, you want more. If it's a situation like that, then getting assigned on a put is actually a great thing. You would be thrilled because you get more shares of something you wanted anyway at a pretty steep discount, depending on how far out of the money you sold this put. You could get it at a 5, 10, 20% discount on those share prices. So
yeah, it's the red flags that people always say is, well, what happens if your covered call gets assigned and you're really out of the money? You would have done better just holding onto the stock, but
you would
at the
have
same
because
time,
yeah. But it's a smaller trade too. The thing is, a covered call is a smaller trade than you just holding the stock without the covered call, right? So if I sell a 30 delta call against 100 shares of stock, well, I reduce my 100 shares of stock, it would be 100 delta, down to 70 delta by selling a 30 delta call. Does that make sense?
Yeah.
So
I suppose,
I took 100 deltas down to 70 deltas. I made the trade smaller. Naturally, my reward, if the trade goes right, is going to be smaller because I've reduced my delta. So, but if the trade goes against me, I've also made my loss much smaller.
Yeah.
So, I mean, it all works out. But yeah, if you really wanted the 100 long deltas, then you would just buy the shares and not do the call. But it just, a lot of times I think people get into these trades and they don't realize, you got to realize what a covered call is. A covered call is you reducing your risk on your shares of stock. Well, you also have to reduce your reward. Nothing is free. To reduce your risk, you have to also reduce the reward, right? You don't get anything free in trading. But the thing is, nobody complains about their covered calls when the stock goes down, which is odd because that's a losing trade. But nobody complains about that. They only complain about it when it goes up. Yeah, I think the easiest thing, though, I mean, your question as far as things you should employ anytime that you want to buy 100 shares or more of a stock, selling a put makes sense. Anytime you have a position that maybe you want to unload some shares on, selling calls makes sense. Maybe selling some at the money calls. That's another thing with covered calls. A lot of times we're trying to sell them out of the money because we really don't want to give up our shares. But sometimes you do want to get out of a stock position. Maybe not you, but like in my trading account, I'm not trying to hold things long term necessarily. So if I end up with 500 shares of ABC stock, and I've made a little money holding those shares, but I'm ready to get out of that position and go put that money to work somewhere else, I may just sell 5 calls right at the money to get a really juicy premium, hoping to get assigned. If I don't get assigned, well, I got really nice premium selling those 5 calls. I'll just the next month I'll do the same thing. I'll sell 5 more right at the money and I hope I get assigned.
I guess that's why people think it's the it's like a goose that lays golden eggs. But it's I mean, it's just remarkable how many different ways there are to trade options and different strategies.
No,
you
a million different ways.
You don't want the shares. It's fascinating.
Because
it's fun to be on this kind of journey. I love learning this stuff.
Yeah, because really, once you get into it, it never becomes about any individual position. It becomes about your total portfolio, really. Like I never put on positions these days. Like if I'm looking Here, my stuff. Here's my MES positions for the current contract. I've got a lot of MES stuff going on. Lots of different stuff. Some of this bullish, some of this bearish, some of it a mixture of both, this ratio spread. You know, I got a lot going on here, but none of these positions I didn't put on because I wanted that individual position. I actually wanted the whole thing together, if that makes sense. I'm thinking about how long or short am I in MES right now? Do I want more long deltas? Put on a bullish trade. Do I want more short deltas? I'll put on a bearish trade. You know, and that's how you end up with all of these different positions. It's not about the individual one position. Especially once you really start actively trading options, it becomes about your entire portfolio, how every trade you make, every new trade you open, how it fits into that puzzle. You know, and a lot of people always, you know, they focus on the individual trade, which when you're new, of course you have to. But as you start learning, you know, rarely is anything about the one trade you make. Mel in the active trading chat was asking about product indifference because the Tasty Trade guys always talk about their product indifferent. And he was under the assumption that product indifference meaning I trade everything and I always trade the same strategies on everything. That's product indifference. That's not what product indifference really means. It's a little bit misleading. Product indifference means they don't care what product they trade, as far as they don't care what it represents. They don't care if they're trading individual stocks, ETFs, futures, you know, whatever the futures represent, whether it be the index futures, the commodity futures, bond futures, crypto, you know, they'll trade anything. It doesn't mean that they'll trade everything. It just means they don't mind trading potentially anything, but it has to have good liquidity, right? You don't trade stuff that's not liquid ever. So it still has to be a liquid product. And as far as trading the same strategy on everything you trade, that's not what product indifference means. Because obviously different products act in wildly different ways. Like the index products like SPY and QQQ, you know, they have that positive drift to the market. There's certain strategies that work on that. Where's all the risk in SPY? Or the ES futures or SPX, you know, whatever, the S&P 500 products you guys love to trade. Where's all the risk? You know, it's always to the downside. The market always crashes down. It never crashes up. All the risk is on the downside. So the puts are richer. You know, it's going to change a lot. There's put skew typically in those products. Changes the way you trade them compared to, for example, commodity futures. So if you're trading things like the metals or the softs, you know, the grains like soybean, wheat, things, where is the risk on products like that? Well, a lot of times it's actually to the upside. It's those things exploding in price, right? Rather than crashing. You know, so it's like completely the opposite. A lot of times you'll have more call skew on some of those products rather than put skew. And then, you know, some products just trade very weird, like the bonds. They don't move the same way, it's the same kind of volatility as like stock futures, oil futures, things like that. So it's not necessarily you do everything the same on everything you trade. Product indifference just means you really don't care what you trade. It's like you don't have a bias, basically.